Global gold market. Key players and their influence. The global gold market is a complex and multifaceted system influenced by several key players, including countries, central banks, mining companies, and investment funds. Each has a significant impact on the supply, demand, and price of gold. Here's a breakdown of these major players and how they shape the market. 1. Central banks. Role and influence. Central banks are significant gold holders and frequently adjust their reserves based on economic conditions. Gold serves as a hedge against inflation and currency fluctuations, so central banks may increase their holdings during times of economic uncertainty. 1. Central banks. Key players. The central banks of the U.S., Federal Reserve, China, People's Bank of China, Russia, Central Bank of Russia, and India, Reserve Bank of India, are especially influential. In recent years, many central banks, particularly in emerging markets, have been accumulating gold, creating upward pressure on global gold prices. 2. Top gold-producing countries. Role and influence. Countries with high gold production have substantial influence over the market. Major gold producers include China, Russia, Australia, the United States, and Canada. These nations benefit economically from high gold prices, as gold exports contribute to their GDP and trade balance. Market impact. Political instability, environmental regulations, and changes in mining legislation in these countries can lead to fluctuations in production, which can, in turn, influence global supply and prices. 3. Mining companies. Role and influence. Major gold mining companies control significant shares of the world's gold supply. Companies like Barrick Gold, Newmont Corporation, AngloGold Ashanti, and Gold Fields are key players. They are responsible for mining, refining, and sometimes selling gold directly on the open market. Market impact. These companies' production levels, costs, and strategic decisions can influence gold prices, especially when significant operational changes occur, such as new projects, mine closures, or mergers and acquisitions. 4. Investment funds and ETFs. Role and influence. Investment vehicles like gold ETFs, exchange-traded funds, mutual funds, and hedge funds significantly impact gold demand. SPDR Gold Trust, GLD, is one of the largest gold ETFs and closely watched as an indicator of investor sentiment toward gold. Market impact. In times of economic uncertainty, these funds often see increased investment inflows, driving up demand and prices. Alternatively, if investors turn to riskier assets, there could be a sell-off, leading to price decreases. 5. Major gold-consuming countries. Role and influence. The jewelry and technology sectors in gold-consuming countries also drive demand. India and China are two of the largest consumers of gold, primarily for jewelry, which accounts for a significant portion of annual demand. Market impact. Cultural events, festivals, and economic conditions in these countries influence gold purchasing patterns. For example, gold demand tends to spike during Diwali and the wedding season in India. Conclusion. These key players create a dynamic environment where central banks influence reserves, mining companies affect supply, investment funds steer speculative demand, and gold-consuming nations drive physical demand. Economic stability, geopolitical events, and market sentiment also shape the global gold market, making it highly sensitive to shifts in any of these areas. Thank you for watching. If you enjoyed this video, give it a thumbs up, and share it with your money friends and associates. Don't forget to subscribe, like, hit that notification bell for more information on money every day, week, month, and year. Let me know in the comments your thoughts on the current information. Thank you for watching.